Financial Argument channel and subscribe to it. In order to support us, please do not forget to like our videos and comment on it with your own views. Finally, you can visit our website address, financialargument.net, and social media accounts for more financial news.
This video posted with permission. The financial and political opinions expressed in this video are not necessarily of Financial Argument or its staff. Opinions expressed in this video do not constitute personalized investment advice and should not be relied on for making investment decisions.
Kenneth Amaduri, and I'm joined today with a brand new guest. We're going to be getting to know Mitchell Feierstein today. He's with PlanetPonzi.com. He's also the CEO of the Glacier Environmental Fund Limited. Planet Ponzi is a blog that loves accountability, transparency, and truth. And we're going to be getting to know Mitchell today. He's got a wealth of knowledge regarding the economy, the investment world, and it's an honor to have him on the show. Mitchell, thanks for coming on.
Thanks for having me here today, Ken. Glad to be here.
Mitch, tell us your story, if you would. And, similar to us here at really connected with your bio, opting out of conventional wisdom. And that's really what I got from you and from the work that you write. So if you would introduce us to yourself a little more and kind of what led you to Planet Ponzi and the things that you do today.
Thanks. Basically, I've been involved in the financial markets for the past nearly 4 decades now. So I've had experience with all the major banks and financial products that there are out there. And when the credit crisis hit, I was sitting at one of the largest hedge funds in Europe. And I was actually sitting at ground zero when the crisis hit. So I decided to write a book, the first insider's version of what really happened behind the credit crisis, which, I see as too much debt, too much credit, and too much leverage. So the 3 tenets of my book are basically how we got into this mess, what happens next, and what you need to do to protect yourself. So it's not really I don't have a non-traditional view. I mean, I do all my own research, and, I've always had a bunch of research people, but I look at all the research myself. I look at all the data points from every economic market around the world, and I make my sound decisions based upon what I think and what I interpret these numbers to mean, and not what somebody else says or what somebody else interprets them to mean. And I think that's far too much of the problem with a lot of the markets and participants in the markets today who don't have a lot of experience. I've seen booms and I've seen busts starting since 1980 when I began in the marketplace, when interest rates, the 10-year bond was trading, around 10.77 or way over 10%. And from 1981, we've come straight down to almost zero in the 10-year bond. So that ride has caused, a precipitous amount of liquidity to slosh into other products and a lot of malinvestment. And I think, what we've witnessed in the last 9 years specifically since the credit crisis is a lot of liquidity being pumped into markets by reckless central bank policy. And I think, anybody who thinks this isn't going to have a ramification is kidding themselves. So, if you want to discuss that, and we can have a look at that.
I'd like to kind of get into that, the you kind of discussed, the platform or, kind of what's behind your investment philosophy. And I'm with you there. So, what are some of the things that you look at now, taking into account, what we've seen in this credit crisis, this, exponential amount of debt that we've seen pumped into the system? Obviously, that's not something that's widely discussed on CNBC or Market Watch. But, obviously guys like you are pointing this out. And so, what does this mean?
Well, I think, I think the key issue is, looking at markets, you've got to think about valuation. What we have in the equities market, the bond market, the credit markets, and the property markets are extreme valuations. I think that this has been caused by the massive influx of liquidity. And unfortunately, I think stocks are more expensive on a value basis than they've ever been in the history of the global markets that we've seen. Pretty much the U.S. market is at a higher valuation than it's ever been. And this takes into account the peak of the dot-com bubble and the bubble in 1929 before we saw one of the biggest crashes in history. So do I think it's sustainable? I don't really think it's sustainable, because when you look at what's happened since the mid 1980s, when you had the peak in interest rates, you know, to today, you've seen real inflation adjusted wages are basically flat to lower, and housing prices are insanely higher, hundreds of percentage points higher. And you've also got tuition prices have increased since the early 1980s by around 3,000%. So what you're seeing a lot of students that are getting out of university highly in debt, and then this creates a problem, and it's a really not sustainable problem, because there's too much debt chasing too few goods out there right now.
Absolutely.
Mhm.
Mitch, so let's discuss this a little bit. And this is something that, we've had to really look at here, because, I'm in a similar camp. I'm not sure exactly, what your investment philosophy has been throughout the last, 9 or 10 years. But, I love sound financial fundamentals. But I have to say, trying to invest solely in altruistic, financially sound vehicles are good for a portion of the portfolio. But, if you completely did that over the last 10 years, you might have bypassed the entire everything bubble and missed out on the, epic returns that we've seen in the stock markets and even the real estate markets that you brought up. And so, what's the balance of this? A smart guy like you able to really see where things are a house of cards, or why this is all a house of cards, but still be able to participate in this manipulated system.
Well, I think, look, if you had your money in stocks for the past 10 years, and you take money off the table now and you put it into, a protected asset classes where you minimize what you want to ensure is you want to ensure return of your capital rather than return on capital right now. And I think there are too many risks involved with a lot of the current markets to be speculating in them. So, you've got to diversify your portfolio and expect that the headwinds that are coming in terms of a recession and a sharp sell-off, you minimize your risk. I don't really give investment advice, but what I'm saying is what I'm doing right now, and what my philosophy would be, rather than telling other people what to do. I mean, if people want to pour into stocks like Amazon with $1 trillion valuation, good luck. Maybe you're smarter than I am, but that's not a place where I'm going to put my money. And neither is a company like Tesla with a CEO that's about to be indicted. So, although millennials are pouring into that stock while corporations and institutions are dumping it, that's probably not what the strategy you want to follow. So, I think what you need to do, and what everybody needs to do, and I talk about it in my book, which is 406 pages, is that you want to look where other people don't look. You don't want to get involved with crowded trades like Amazon or Apple, because you're in the ninth inning of those trades, and they're really, really crowded. And whenever there's a really, really crowded trade, you're most likely going to be getting into trouble. So, you want to kind of steer clear of that. And I think what you've got to think about is what's happened in the past 9 years or 10 years is what the U.S. has done with interest rates. They've brought them down to like zero. But this has been a coordinated effort with the Bank of Japan, the European Central Bank, and the Bank of England, and the Federal Reserve in the U.S., all pretty much on the same page to provide endless liquidity. So, the next crisis, I don't know what's going to cause it, but right now you're seeing massive crisis in Venezuela, Argentina, Brazil, Turkey, whose currency has collapsed 30%. So, these are bad signs and troubling signs. And accordingly, our stock markets in the U.S. are near all-time highs. So there's been a fundamental disconnect. Now, there's got to be credit exposures from the U.S. to these other markets. So I think that too many people are becoming far too complacent and don't realize that there's risk in every market. And the Federal Reserve isn't going to have your back all the time, or they don't have enough bullets left in their toolkit to bail everybody out.
Mm-hmm. I tend to agree with you, Mitch. So Trump hasn't received much credit from the mainstream media from the numbers that have been reported since the election. And it's kind of a dichotomy, because I believe that there's certain things that Trump is doing that are fundamentally sound for the economy. I think he made the economy, a more attractive environment for business. Obviously, a lot of the regulations, and it's cheaper now to do business here because taxes are down. Um, so I think these are actually very good. And, actually, Obama is now coming out and saying, hey, wait a minute, just remember when this recovery started. But I think there was a lot of good that Trump actually did on top of that, because, again, he really started to get businesses and entrepreneurs excited to invest domestically here in the U.S. But at the same time, here we are talking about the inevitability of a turnaround. And I'm wondering, do you think this will happen on a Trump watch here? And obviously the media would love that, to be able to blame a conservative-minded person, a conservative ideology on why things are going to crash.
Look, Washington's been a cesspool of corruption for the past 40 years, trying to push neoliberal theory, which has proved to be a failure. Because the recovery, quote, recovery, unquote, that we're seeing it's all a mirage, and it's based upon the Fed's providing of liquidity, hundreds of trillions of dollars in liquidity. The United States has around $260 trillion in debt. And to get to that number, 260 trillion, I go into detail: Medicare, Medicaid, social welfare entitlement programs. You've got to look at all the liabilities that the government has, legally binding obligations which they have to pay. So do I think that the change in leadership is going to make a difference? I think that certain programs, look, Trump wants to try to change the corrupt system that's been going on in Washington for 40 years. So everybody is fighting against him because, it's an easy payout. What exactly has the government done for anybody in the past 20 or 30 years? Nothing. It's been the status quo. And we've got endless wars that we're funding for trillions of dollars we don't have all over the planet. But who makes money on that? Look at the stocks of Boeing, Lockheed, and the other military industrial contractors. That's not a way to make America, middle America, and people in America make money specifically. So what we need to do is we need to figure out what's going to happen next and how we're going to pay the amount of debt that we have. And that, I think, is going to be the tipping point for the U.S. But the spark that starts the fire, I don't know if it's going to be in the emerging markets or if it's going to be in the EU, because Italy, watch Italy mid-October. They're going to come up with some ideas on what they want to do. But quite frankly, the new government that's been installed there has come out and said they're going to repudiate the $4 trillion worth of debt that they have. So unless the European Central Bank thinks they're going to wade in and buy all those Italian bonds, I don't know what can fend off a crisis, a crisis in Europe, unless the EU changes their legislation to allow monetary financing and allows the ECB just to buy up all that debt. But if that happens, eventually you're going to have some kind of hyperinflationary event, where there's going to have to be some other credit event, because corporate bonds are mispriced as a result. All corporate debt is mispriced as a result of the central bank interventions in the various markets around the world. And corporate bonds has to be rolled over in the next 2 years. There's trillions, I don't know, $4 trillion worth that need to be rolled over. So I don't know where all the demand for this paper is going to come from in the U.S., Europe, and around the world, with the refi at the lowest interest rates in history, pretty much. So,
Mitch,
I don't see a way. I don't see a way out of this.
Yeah.
Uh-huh.
Okay. So, and I'm with you there. And so, one thing that I feel like the U.S. has benefited from is being the cleanest shirt in a basket of laundry. Maybe you would disagree that it's the cleanest shirt, but let me finish here. Is it possible to have this whole system collapse at once? Like every Western nation, every Eastern nation just going into this debt crisis? Or does there need to be some sort of outlet? Meaning, like, is there some sort of jurisdiction that's going to do better while a certain jurisdiction goes down? Kind of like a zero-sum game, if you will. And and if that's true, if we have all these problems around the world, will that continue to support the U.S. and keep the U.S. artificially living well?
Yeah, what you're talking about is U.S. dollar hegemony, probably. But what you've got to look at, if you're looking to see who the cleanest shirt is you've got to look at every global economy and figure out which economy has the least amount of debt. So, and which one can function and isn't going to have counterparty risk and isn't going to owe tons of money to someone else that they have to default on, and then people won't want to lend the money, because that's eventually what's going to happen. You're going to have credit events. So you want to find the least risky place to keep your assets when you have a time of uncertainty. I mean, I think if you look at what happened in Cyprus can be the model. When you had Bank of Cyprus fail 2 years earlier, Euro Money came out and said Euro Money came out and said that Cyprus was perhaps the safest international place to keep your money. Bank of Cyprus was, and then obviously you had the bank failures, and they had bank confiscations that basically took back anything over 100,000 euros in each account. So the next time it's not going to be bail outs, it's going to be bail-ins, where they just confiscate depositors' funds over a certain amount. So I think that what you need to do, as I said before, is look to manage your risk and make sure that you don't have too much of a concentration somewhere that could go out of business.
Those good words right there. Well, Mitch, if people want to learn more about you and the work that you do, and ways in which they can access your content and your books, please let them know about your website and everything that you're offering. Appreciate you coming on the show, by the way.
Yeah, sure. Thanks a lot. I mean, they can keep up to date on my stuff on www.planetponzi.com or Twitter @PlanetPonzi. And if they want the book, it's on Amazon.
All right. Well, Mitchell, thanks for coming on.